Hey everyone, Travis here, the Stock Geek, and today's video is all about the debt ceiling crisis in the US. Now, you hear a lot about this debt ceiling crisis, but you don't see a lot of actual details on what it is, what it means, looking back at historical debt ceiling crises to try to figure out what the real impact will be on the economy and on your portfolio. So that's what I aim to do in today's video. I'll even give you some potential trade ideas today for ways to protect your portfolio against the worst case scenario outcome of a debt ceiling crisis. All right, so let's talk about the current US debt ceiling crisis. It's a completely avoidable and manufactured crisis, yet it's also a very real threat to economic growth and to potentially your portfolio. What is the US debt ceiling? Well, it is a limit that the US Congress has placed on the amount of debt that the US Treasury can issue, thereby limiting the US government's ability to take on more debt for spending. Now, when the US government hits that federal debt ceiling limit, which is currently at $31.4 trillion, what that means is they're unable to issue any new debt beyond the amounts of debt that are currently maturing. And once the Treasury runs down their spending balances, that essentially means that the US government is forced to spend in line with their tax revenues. And I'll talk about the implications of that here in a minute. So the current US federal debt ceiling limit is set at $31.4 trillion. The US debt limit was actually hit in January of 2023, so the US has not been issuing any new debt other than to replace maturing debt. And in fact, US total debt was above $31 trillion as far back as last October. $31.4 trillion. It's an almost unfathomable number to your average citizen. And people have worried about the level of national debt basically since the US was founded, certainly every year since I've been alive. But how do we put that $31.4 trillion number in context? It represents the total amount of US government spending, the cumulative amount, over the level of tax revenues over many decades. It also happens to represent about 120% of current annual nominal US GDP. Now, 120% of GDP is basically the highest level of debt to GDP we've been at since World War II, and it's basically the highest level of debt to GDP the US has been at in relative peacetime. However, Japan proves that there isn't necessarily a hard limit on the total debt that a country can have relative to GDP, because Japan is currently sporting a 263% debt to GDP ratio, and the US is basically where Japan was back in 1999. This is true at least for countries like Japan and the US that print their own currencies, by the way. However, a high debt to GDP ratio does mean that a country is having to spend more and more of their budget on interest payments on the debt, and so it leaves less for other spending priorities. In any case, the US has been adding to its national debt at a faster and faster pace in recent years, and we saw deficits, the amount between tax revenues and annual spending, balloon to about 15% of GDP during the COVID timeframe. Today, the deficit is running about 5 to 6% of GDP, and it's expected to remain in that 5 to 6% level in the near future, according to projections from the Congressional Budget Office. Now, both Republicans and Democrats are responsible for this. The US has been running deficits under Republican and Democratic administrations for many years, so we've been running deficits under both parties over the past 2 decades, including under Presidents Bush, Obama, Trump, and Biden. Certainly both parties are at fault here. Now, hitting the debt ceiling and exhausting all other measures would mean immediately slashing up to about a quarter of the federal government budget, since running a deficit here would not be possible if the debt ceiling is hit and the Treasury has spent all the money in its Treasury General account. So these huge spending cuts, if forced, would have an immediate negative effect on the overall economy. In fact, investment bank Morgan Stanley estimates that it could be an 8 to 12% hit to overall consumer spending and potentially as much as an 18 to 20% hit to overall GDP, which would be on par with some of the largest declines in GDP in history. We're talking depression-level hits to GDP if we had that worst-case outcome. A key point here, however, is of course that the US wouldn't necessarily default on its debt, meaning it wouldn't necessarily stop paying interest payments because they could potentially prioritize interest payments on the debt over other areas of government spending. But how the spending would be allocated or prioritized is a big unknown today. And a federal government shutdown of some level would likely be necessary if the government can't decide on a compromise to raise the debt ceiling. So to finance its current spending levels, the government is going to have to come up with some type of solution. So where do we currently stand as of May 18th with regard to the US debt ceiling crisis? Well, as I mentioned, the US has already hit the debt ceiling, so it can't issue more debt than the amount of debt maturing, and the Treasury has been slowly running down its operating balances in its accounts to continue funding the government. But eventually the Treasury will run out of funds. The date at which it runs out of funds is called the X date. And we don't exactly know when that X date will be because there's some uncertainty around how much tax receipts Treasury will take in over the next few weeks and months, but it's believed that the X date could come as soon as June 1st or as late July. Now, the Treasury itself, I believe Janet Yellen, the Treasury Secretary, has said that she believes the Treasury could run out of funds by June 1st. The Congressional Budget Office also believes that the Treasury could run out of funds if it doesn't make it to June 15th when there's a big tax inflow. And you can actually see what the daily closing balances are for the Treasury's general account. Every few days, it'll post what the closing and opening balances were. As of May 16th, the closing balance of the Treasury general account was down to $94 billion. That's down from $300 billion at the beginning of May. So it's running down pretty quickly. It's expected to keep running down, and it will have some big withdrawals on June 1st. However, the Treasury has some other extraordinary measures that should be able to give it about a $50 to maybe $80 billion headroom to try to get to that June 15th date, at which point, if it makes it to June 15th, they'll take in more tax receipts and potentially push out the X date until late July. I know it's very confusing. There are people on Twitter such as John Comiskey who are forecasting the daily balances, and he has a very detailed breakdown of what he thinks the deposits and withdrawals will be by day and what that means for when the X date will be. He believes the X date, for instance, will be in late July. Regardless of when that X date actually comes, it's clear that there isn't that much time for Congress to act to try to come to an agreement on raising the debt ceiling to avoid a major financial crisis. So how did we get to this crisis point? Well, the stage was really set back in 2022. During the midterm elections, the Republicans gained a majority of seats in the House of Representatives, while the Democrats retained a majority of seats in the Senate, as well as the seat of the presidency with Joe Biden. This set up a very divided government. And as we know, Republicans and Democrats have very different views on where the government should be spending, as well as the appropriate level of federal government spending. So we have a very divided Congress with very different views. And back in 2022, before the midterm elections, the Democrats actually passed what was called the Inflation Reduction Act. Now, despite its name, the Inflation Reduction Act actually allocated spending to areas like alternative energy, climate change remediation, extensions of the Affordable Care Act, or what's known as Obamacare, areas that the Republicans really don't want the federal government to be spending increasing amounts of money on. Now, to help pay for some of this, at least, the bill also set corporate minimum taxes and imposed a 1% tax on stock buybacks. But overall, this is seen as a spending bill that the Republicans really didn't want. And in addition, Biden recently proposed a $6.8 trillion budget for fiscal year 2024, which has all this spending for new social programs, child care, early childhood development, of course, higher taxes on the rich, things that the Republicans also really hate. Now, the House of Representatives, led by the Republicans, recently passed their own debt ceiling hike, which was meant to spur talks, but they were willing to raise the debt ceiling in exchange for cuts in spending. Not only do they believe that Biden's budget is dead in the water and they won't vote for it, but they're also saying that they're only going to raise the U.S. debt ceiling in exchange for cuts to existing spending, particularly in areas like alternative energy. Of course, Biden and the Democrats want what's called a clean debt ceiling bill, where both parties decide to raise the debt ceiling without any conditions, but it likely won't happen this way. We've seen certain fringe areas of various parties talking about ways to handle the debt ceiling. Former President Trump says that the U.S. should just allow a default on the debt unless the Democrats give in. Of course, the Democrats have talked about using the 14th Amendment of the Constitution to just raise the debt ceiling or keep spending, because there is a provision within the 14th Amendment that says the U.S. government will always honor its debts, or something similar to that effect. However, it's never really been tested. It would likely go to court. And regardless of what you believe on either side, it's clear that both sides are not really that close to an agreement. There has been some optimism in recent days that in the talks that the Republicans and Democrats have had this week, that they're making some progress, but we do not yet have an agreement, and it's unclear when this will actually be resolved. In the past, it has always been resolved, but not always in the cleanest fashion, and certainly not always in a timely fashion. So let's look back at some of the previous debt ceiling crises to get an idea of how the current one might play out. So the first relevant debt ceiling crisis in the modern era happened in the fall of 1995. Democrat Bill Clinton was president, and the Republicans had just gained a majority of seats in both the Senate and the House of Representatives in the 1994 midterm elections. Now, the Republicans wanted a cut in spending as well as reforms to Medicare in exchange for raising the current government debt ceiling, which was then set at $4.9 trillion. President Bill Clinton, of course, did not want to do that. He saw that as holding the country hostage over the debt ceiling, and he vowed to veto any Republican bills that cut spending in exchange for raising the debt ceiling. The Republicans did pass those bills, and Clinton did veto a bill in November, leading to a government shutdown for 5 days. Now, eventually, the Democrats and Republicans gave a short-term extension on the debt ceiling, but the government shut down a second time in mid-December through early January. Eventually, the stalemate was resolved in late March of 1996 when the Republicans and Democrats agreed to minor spending cuts in exchange for raising the debt ceiling to $5.5 trillion. Now, during this crisis, surprisingly enough, stocks actually performed pretty well, actually. Stocks really weren't down more than 3 or 4% at any point during the debt ceiling crisis. We also saw that gold was pretty weak, surprisingly. You would think that gold as an alternative asset to perhaps the US dollar or treasury bonds would have performed pretty well. It only had a very short period during January 96 when it had a little bit of a pop, and afterward, after the resolution, gold sold off pretty dramatically. Interestingly enough as well, we saw government bond yields, treasury bonds, actually go down, and the price of treasury bonds actually go up during the crisis period, which is perhaps a little bit surprising. Most people would think that if there was a potential debt default on the table, that the price of government bonds would plummet, that yields would rise, but actually the opposite has happened in almost every debt ceiling crisis in modern history because treasuries are still seen as a safe asset. They're actually seen as a place to flee, especially if the debt ceiling leads to recessionary impacts, major cuts in federal spending, which would hurt the economy. And so no one in the market has tended to believe that a debt default was really on the table, even during these crisis moments. And so you can see here the decline in yields and the rise in bond prices. Here, of course, we see that yields went down and bond prices move inversely with yields. So bond prices actually went up during this 1995 crisis time. We now fast forward to the summer of 2011, and Democrat Barack Obama was president. The Republicans had just taken a majority of seats in the House of Representatives in the 2010 midterm elections. This is all sounding very familiar, right? Similar to what happened in 1995. Federal deficits had been running at very high levels after the global financial crisis, and Republicans wanted spending cuts to match the level of any debt ceiling increase. They also wanted to potentially eliminate the deficit altogether, essentially have a balanced budget, while the Democrats wanted to have a large debt ceiling increase without changes to things like Social Security, Medicare, Medicaid programs, etc. The debt ceiling was at that time $14.3 trillion, and it was reached in April of 2011. And the Treasury was, of course, running down its Treasury General account to fund spending through the summer. But there was a X date coming in August of 2011 where the Treasury would actually run out of funds, and there'd have to be either a government shutdown or very difficult decisions made about where to spend in terms of government spending. And resolution came on August 1st of 2011, 3 days before the Treasury ran out of funds, with the passage of the Budget Control Act. The Budget Control Act was a compromise bill that raised the debt ceiling $900 billion in exchange for some spending cuts that would be enacted over the next decade. Now, interestingly enough, the performance of the assets was very different than what we saw in 1995. Gold did rally. Gold was up almost 20%. It was up about 10% leading up to the X date, and actually up almost another 10% after the resolution bill was passed. Bonds did rally, so we did see bonds up through the crisis period like we did in 1995. But unlike 1995, stocks were actually down significantly. The S&P was down almost 10% during this period. The small cap Russell index was down almost 15%. And a lot of that negative performance actually came after the resolution bill because the market saw the cut to federal spending as very negative for the overall economy. Another thing that happened during this time was that Standard & Poor's actually downgraded their rating on U.S. government credit from AAA down to AA+, and that also caused some of the short-term market volatility. So it was a very interesting time during 2011. This was the time when we actually saw what you might expect during most debt ceiling crises, where you'd think stocks would sell off, gold would go up, You still would maybe expect that bonds would actually sell off, but here again, bonds actually rallied. Treasuries did just fine during this period. So the market, even with the downgrade of the debt, didn't really think a default was actually going to happen. So very interesting to see the performance of assets during the 2011 debt ceiling crisis. It might tell us something about what could happen in a nastier type of situation if we get that during the current debt ceiling crisis. Now, Obama also had another debt ceiling crisis just 2 years later in 2013 with another major debt ceiling fight between Democrats and Republicans. Once again, Barack Obama was president. Republicans controlled the majority in the House of Representatives, and the debt ceiling was currently at around $16.4 trillion at that time, and the debt ceiling was reached on, I think, December 31st, 2012. And so we were into 2013. The Treasury was using extraordinary measures, running down its Treasury General account. The Republicans, again, wanted a debt ceiling hike to coincide with defunding Democratic spending programs such as the Affordable Care Act, otherwise known as Obamacare, in exchange for raising that debt ceiling. So this led to a partial government shutdown in October of 2013. So the Treasury essentially ran down their operating funds and there hadn't been a compromise reached yet. So the government shut down briefly in October of 2013. And a compromise bill was eventually passed. The Continuing Appropriations Act of 2013 was passed on October 16th. During this debt ceiling crisis in 2013, we once again saw stocks really not react that negatively. This was more similar to 1995, where stocks just kind of shook off the whole issue. You know, stocks probably looked at the 2011 timeframe and said, well, ultimately both sides are going to come to a resolution. Ultimately, things will get worked out, and stocks just kept chugging along through the 2013 crisis. Stocks actually ended up after the crisis pretty nicely. Bonds were also up, but only just slightly, so they continued to be relatively resilient, but didn't provide that much return. Gold was down significantly during the 2013 debt ceiling crisis. So unlike 2011 and more similar to 1995, gold actually performed quite poorly through this 2013 debt ceiling crisis, not really providing a hedge whatsoever. So overall, 2 out of 3 times stocks did pretty well. 2 out of 3 times gold didn't really provide that much hedge or positive return. And bonds overall actually performed the best out of most of the major asset classes during these debt ceiling crises, which is maybe not what people would expect, right? You'd think that if there was a potential default scenario on the table, even if it was a very small probability, that bonds would actually sell off. But no, Treasury bonds still seen as a safe asset, still seen as a safe place to hide, and potentially seen as a way to play a massive cut in federal spending if that's what results from the debt ceiling crisis. Now, could the same thing happen in 2023, or might things be different this time? Well, interesting to look at credit default swaps, which are instruments in the credit market that reflect the potential probabilities of default on bonds. And when you look at the credit default swaps currently, the pricing of CDS on US government treasuries are reaching pretty high levels. They've spiked a lot just in the past few months, suggesting the market believes that there could be a higher chance of potential default on treasuries this time around. And so the US bond market, the CDS market, is signaling that the markets are getting more nervous about a worst case scenario. Stocks, however, of course, really not reflecting that currently. You know, the S&P today has mostly just been chugging higher. The NASDAQ's been chugging higher. The NASDAQ is up year to date 25%. Stocks like Nvidia seem to go up every day. And so the market really, on the stock side, doesn't seem that concerned about a worst case scenario today, at least on May 18th. Things could obviously change if we get to a situation in early June or in July and things aren't resolved and things are going south, of course. But right now, equities shaking off this potential issue. Okay, so what happens here as we approach June or late July with the X date? If the government has not raised the debt ceiling through compromise, what are we looking at? Well, obviously the Treasury, as it runs down funds, would not be able to continue spending its current programs, at least not at the full level. There would be a partial government shutdown. The Treasury would have to prioritize certain types of payments, likely things like Social Security, Medicare, Medicaid, military salaries, interest payments on debt. What happens in a truly worst case scenario where Treasury decides or is unable to pay interest on debt? Very, very unlikely. Less than, I would say, a 0.2% probability. But what would happen? Well, I think what would happen is we'd see a very significant, potentially greater than global financial crisis impact on financial markets. You'd have an immediate massive drawdown in stocks. You would have counterparty defaults. Anyone holding treasuries would have assets that are immediately non-performing. So banks would be completely insolvent technically. You would have probably a decline in the dollar against other currencies. You would probably have a spike in things like gold and cryptocurrency, alternatives to the existing dollar. Certainly in dollar terms, I think those things would spike. You would have a big hit to any stocks that have exposure to government, so anything in the defense sector. A lot of companies that have federal spending exposure would be hit. In fact, those would probably be hit even in a mild government shutdown scenario, even without a default on the overall US government debt. So what's most likely? Of course, the most likely scenario is that even if we get a government shutdown, if we reach the X date and there's no compromise reach, it's likely that there'll be a prioritization, but also a partial shutdown, and a compromise will be reached very, very quickly. In that scenario, stocks could maybe just ignore the whole thing like they have several other times, or there could be a short-term drawdown before stocks recover. It depends also on the magnitude of federal spending cuts. If in this compromise scenario, there are deep, deep cuts to federal spending, then essentially you have forced austerity, and you could have a potential big impact on the economy, which is already a little bit worried about potential recession as we go into later this year. So that would be a potential impact as well. You could see yields decline and bonds rise in that scenario, although we do have a very inverted yield curve already, meaning as you look out 2, 5, 10 years on the yield curve, the market's already saying that rates are going to need to be cut and bonds have already traded up when you look at later dated maturities. So interesting to note that we don't know exactly how the bond market performs, potentially different performance across different parts of the yield curve there. Now, what are some trade ideas? How can we not only protect ourselves against a truly worst case scenario, but how can we protect ourselves and position the portfolio in a typical compromise scenario? Well, one thing obviously is that there is some cheap ways to play a truly worst case scenario, things like calls on GLD, the gold ETF, or call spreads. That would be one way. Calls on the VIX, another thing that is relatively low price today, despite the fact that we're in this debt ceiling situation. We also, of course, have equity markets hitting pretty high levels, particularly things like the NASDAQ. So you could take a bearish bet on the indices through shorting the indices, the ETFs, owning something like SH, which is an inverse ETF, or even taking put spreads or puts outright on the indices. So that would be another way to play it that's relatively cheap. Another way to play it could be buying things like SR3 futures. These are interest rate derivatives, interest rate futures that reflect where rates are expected to be in the coming months and years. And so you could actually make a bet that interest rates will need to get cut. Remember, we've seen a pretty significant increase in rates from basically 0% up to a 5+% rate on Fed funds in less than like a year and a half. And so there are a lot of people out there that believe, myself included, that the Fed has already gone too aggressive. We've seen inflation numbers cooling and rates need to come down. And if you were to get into a fiscal austerity situation, then you would really need rates to come down because you'd be fighting recession at that point and the Fed would need to cut rates. So you could bet on the rate cut scenario through something like SR3 futures, and that would be a very leveraged way to play that trade as well. Now, betting on a typical compromise might just mean ignoring things and going on with your life, especially if you're a longer-term buy and hold investor who's dollar cost averaging. Then some of these short-term things just don't really matter ultimately, especially if you're a younger investor. So doing nothing is also an option here. That's always something to remember here, and certainly something that we can always utilize. It's just doing nothing and ignoring all of this, because that's worked pretty well in some of the past debt crises. Now, as far as areas or sectors within the market that could do poorly during a debt ceiling crisis, anything exposed to federal government spending, things like defense stocks could take a hit, things like Palantir, Boeing, Lockheed Martin, Raytheon, et cetera, could actually take at least a short-term hit if there's some uncertainty about levels of government spending going forward. So those would be an area to be cautious of if we do get into, deeper into the debt ceiling crisis here in 2023. So the debt ceiling crisis, it's this completely avoidable, self-inflicted, annoying thing we have to deal with now every few years in markets, especially when we get a divided government, and it's completely unnecessary. So what can we do about it? I personally think that we should reinstate what was called the Gephardt rule, which was in place for a number of years in Congress, where if Congress passes a budget, then the debt ceiling is deemed raised to the level necessary to actually accommodate that budget. And so what it does is it marries the debt ceiling with the budget setting process. And that would help to avoid this extra time when we have to deal with this whole debt ceiling thing. And it would also help to relieve some economic uncertainty. And of course, we still need fiscal reform. We can deal with fiscal reform outside of the crisis period. The time to actually reform federal spending and bring down the deficit level is a time when we can actually have informed arguments and no one's holding the government hostage over this completely manufactured debt ceiling issue. So that's my opinion. We could also vote for better decision makers and more moderate politicians, although who knows if that will ever happen. But hopefully we can avoid the worst case scenario in these debt ceiling crisis. We'll see how it all plays out here in 2023. We'll know a lot more in the coming weeks. But stay tuned to StockGeekTV. I'll do my best to answer any questions or concerns you have in the comments. Until next time, everyone, hope you have a great day. Cheers.